Hello, good morning, everyone, and welcome to today's webinar. My name is Vera Osuji. I work with Credit Registry, Credit Bureau PLC as the Senior Head, Sales and Business Development. Well, before we start, I will want you to do a task quickly. It promises to be an interesting one. So for everyone out there as the attendee, kindly go to the chat box, not the Q&A, and drop the name of your organization, your role, and if you could have any occupation, what would that be? Perhaps it's something you imagined when you were a kid. So let's just interact virtually. So I'm going to allow for us to interact virtually for the next 1 minute. Then we just start the webinar. Oh, I can see a chat on the Q&A that the chat box is disabled. It's going to be enabled soon. All right, while I allow for that to be enabled, I'll just go ahead, and once that is done, you just go ahead and interact virtually. So today's webinar is organized by Credit Registry. And I want to also say thank you once again for joining us today. And today, the next 2 hours you're going to be spending with us is going to be quite insightful and worth your time. So this webinar is the maiden edition of our Market Plus series. And what that means is that in future, we're going to be having a couple other webinars and seminars of Market Plus. Now, the title of today's series is National Credit Insights and Economic Trend Pre-2023 Election. And today we will discuss the credit landscape in 2022 with an overview on the national debt and individual credits, economic trends, and we'll look at the probable influence of 2023 election campaign on the factors that I have just mentioned. So without much ado, I want to take us to the house rules. Oh, I can see the chat box is open, yes, so just go ahead. Oh, quite some interesting responses. Someone said she wants to be a pilot. Well, let's go ahead and interact virtually. So our house rule today is, I want to let you all know that this webinar is being recorded and every participant is muted. And should you have any question, please type the question in the Q&A box. And you can also raise your virtual hand feature on your Zoom. And should you lose your internet connection, please just reconnect with the same link with which you used to join us. I choose not to be distracted. Someone says she wants to be a professional dancer. Then this webinar is going to last approximately 2 hours and 30 minutes. So I want us to look at what we're going to be doing today in general. So today we're going to start off with a keynote address, and then the next speaker is going to talk about Nigerian lending landscape, the bigger picture, 2022 macroeconomic forecast vis-a-vis prevailing economic trends, pre-2023 election. And you have a session for your story, election and lending. And for that particular session, we have Fidelity Bank and Fair Money speaking to us on their experience in 2022. Now, I want to also say that we have a group of astute and ingenious speakers today that will make our time here worth the while. So today, may allow me to introduce, we have Dr. Jamila Sharif, the Managing Director, CEO of Credit Registry, Credit Bureau. We also have Dr. Vincent, he is Vice President, Research, FMDQ Group. We also have Abiodun Kiripe, he is the MD, CEO, Afro Invest Research and Consulting. Today also, we're going to be listening to Mr. Kelvin Ugoke. Mr. Kelvin is the ED and CRO of Fidelity Bank. And we also have Mr. Henry Obiake. He is the MD, CEO of Fair Money Nigeria. We look forward to hearing you all speak. So at this point, allow me to introduce the first speaker who is going to be taking the keynote address. So today, ladies and gentlemen, I am delighted to introduce to you Dr. Jamila Sharif Ayedu. Dr. Jamila Sharif is the CEO, Managing Director of Credit Registry. She is officially our host for today's event. She is also a co-founder of Credit Registry Corporation, a software company that is headquartered in Washington State, in the United States of America. Under her leadership, Credit Registry has won numerous awards that I may not mention right now, but I want us to know under her leadership, the organization was selected as Africa's top 20 most innovative companies by Financial Times magazine. Prior to her expansive career in Credit Registry, she had a rewarding engineering career with General Motors in North America, South America, and Europe. And she also worked with Microsoft Corporation as Global Program Manager. Dr. Jamila has received numerous awards herself. She has also received the CEO Today's Global Award, and she is recognized in the top 30 leading women in fintech in Nigeria by Financial Technology Africa. So Dr. Jamila, over to you, ma'am, to give your keynote address.
Thank you very much, Vera. I am excited today. I want to say, first of all, welcome our esteemed guests. We have our customers, partners, regulators, and colleagues in this meeting. So I want to say thank you for joining us. It is an honor for me to address you today. as we come together to really discuss what we call the market pulse. Let's talk about national credit insights and the trajectory of our economy as we approach Nigeria's 2023 election. On this topic, I am privileged, and I'm going to actually take a moment to just roll in who our speakers are today. They are financial industry veterans, and they have taken time out today to come to us, and with all the research that they've done, they've put together some insightful information, and they will address nearly every touch point that you have been asking us about. When you registered, I want to thank you for submitting so many questions when it comes to your money and our economy. So please join me right now with a virtual applause. I want you to literally in your chat box applaud right now for all of our amazing speakers. If they've given you money, if they've managed your investments, if they help you look after your savings, if you want them to give you money, also put an applause there. Yes, yes. We have Mr. Abiodun Karipe. He is the MD of Afrinvest Consulting. He's a seasoned investment and financial analyst with over a decade of experience here in the Nigerian capital market. We also have Dr. Vincent Nwani as the head of research, of course, at FMDQ Group PLC, with 19 years as a veteran in economics, research, and business advisory. Welcome, sir. Thank you. And then we have Dr. Henry Obieke. He is the managing director of Fair Money Nigeria, the fintech, investment banking, and capital markets guru with 15 years of expertise. And last but not least, I want to welcome a heavyweight champion, seasoned banking professional coming in with 32 plus years of experience in banking operations, corporate lending, risk management, and compliance. Mr. Kevin Uguake, thank you so much. He's the ED, Executive Director, CRO, Fidelity Bank PLC. So yes, you can hear that I'm excited because this is serious. We are all going to be well fed with knowledge during this lunch period. So thank you for joining us during this time. The unique and versatile perspectives of our speakers is going to provide us with valuable insights as we plan for what's to come. And that's powerful. So let's get them ready. They're listening to us, right? So in the comments, I want you to take a moment and type what you need help with. When it comes to your greatest financial challenge right now, they're listening. What do you need help with? What is your greatest financial challenge? You may be like me. I have kids that are in college that we're paying money for, and I'm concerned that we should have an economy that is going to welcome them with gainful employment. Are there investment areas right now that you're looking for? What's your greatest challenge? Are you just trying to pay off maybe some medical bills? Trying to buy a house? Maybe you want to ask the love of your life to marry you. Maybe you need business credit, or you're trying to service a contract. Whatever your challenges are, let's let them know. I want you to be ready to ask them questions. So as the CEO of Credit Registry, I do want to attest that the credit market, at least credit to the private sector, has steadily increased over the last 2 decades by over 3,800% here in Nigeria. At the end of 2022, credit to the private sector had increased and reached over 41.6 trillion naira. This is a testament to the hard work and dedication of our financial sector echo players. And I'm talking about the banks, the fintechs, and even MFBs, OFIs, switching companies, payment solution providers, regulatory interventions, and so many other infrastructure enablers, including credit bureaus like Credit Registry. But let's be honest, people, we are not where we need to be. So we're going to delve deeper today in this discussion. We're going to be honest with ourselves. We're going to focus on those key areas that our moderator spoke about, the economic trends, monetary updates, even the elections and lending. So as we move closer to this 2023 election, I encourage us to stay abreast of these political changes that our government and the government policies that are being put in place. because it will impact our money. And we need to hold our leaders accountable for promoting a healthy credit market. We care. Yes, we care. And this is how much. In August of 2022, there was an estimated 96.3 million people have registered to partake up in these next elections. Yes, we care. If you care about our economy, you care about our future, please type it in that chat box. Yes, we care. It is representative of a significant increase. You can type, yes, we care. Yes, we care. So it is an increase from over the prior election period, which was in 2019, where there were 84 million who had registered. So that's a 14.6% increase. We care. At Credit Registry, we also care. We're committed to seeing a healthy credit market. We're providing relevant and comprehensive credit insights. We support our clients and even the public at large when it comes to informed financial decisions. We care. Whether it's identity management, fraud prevention, portfolio management, collections, scoring, analytics, and more, we care. We have an epic nation that is dedicated to fostering a strong credit market, driving economic growth right here in Nigeria. And our promise to you today is to connect, trust, and empower. And that's why we're bringing you today the Market Pulse. So in closing, I want to encourage you all to get actively engaged. Thank you for typing in the chat box. Continue to let your voices be heard because we are listening. I look forward to an engaging and informative conversation. Together, let us continue to build a strong and more resilient credit market for this nation. Enjoy this webinar. Thank you and God bless. Vera, back over to you. Thank you, everyone.
Thank you, Dr. Jamila, for that keynote address. It has left us quite excited to hear all that our oracles in today's webinar has to say to us. So, ladies and gentlemen, I am excited to introduce the next speaker to us. So, meet our next speaker. Our next speaker is Dr. Vincent Nwani. He is the Vice President, Research FMDQ Group. He has over 19 years experience in economics, research, intelligence, business policy advocacy, and business advisory functions at various institutions such as Carvin Limited, First Bank Nigeria PLC, BGL Group PLC, Margaret Finance and Investment Limited. Prior to joining FMDQ Group, he served as the director at the Lagos State Chambers of Commerce and Industry. He holds a doctorate degree in economics from Monarch Business School, Switzerland, a master's degree in economics as well from University of Ibadan, and bachelor's degree in economics. I love that consistency, Dr. Vincent. So Dr. Vincent, with a whole lot of applaud that you can see on the chat group happening here, over to you, please, to go on with your presentation, sir.
Thank you, Vera, for the introduction. Personally, I'm excited to join this webinar. And on behalf of the management, the board and staff of FMDQ Group, we thank you for inviting us to participate in this important meeting and webinar. Dr. Jamila and other speakers, including attendees, we are very happy to be here. You know, I've been asked to ventilate the topic, Nigeria's lending landscape, the bigger picture. And that is my job here this morning. I'm going to take you through just a few slides. I have about 20-25 minutes before we go into the Q&A. So this is just to whet our appetite and wait for the Q&A session. So I'm going to be providing the lending landscape through the market dashboard. Then from there, just look at some game changers over the years and where we are presently. Look at the outlook of the lending market, especially in post-election period. Then what would be the role of key stakeholders in unlocking the lending market. Just like Dr. Jamila said, she said that we've made a lot of progress, but we are not there yet. Clearly, we are not where we should be, and I will conclude by just emphasizing the fact that FMDQ is important in deepening this market and taking Nigeria and this market to where it should be as far as lending, credit, debt, markets, and securities is concerned. Having said that, next slide, please. Yeah, so what we try to do here was just to look at the trends of credit to private sector. And the truth is that it's been growing steadily, it's been improving, whether it is election, pre-election year, post-election year, we did not see any indicator that election year or post-election year impact on the growth or trends of credit to the private sector. And the other information here is about GDP. Of course, GDP maintained a random walk, staggered walk all through the years. And you look at those, the bar on the yellow bars, those are election years, and you find out that the interesting thing is that for election year, you see stronger GDP growth compared to the year following the election year. And this is not what we want to see in 2023 and 2024, where, of course, the GDP growth in 2022, we've seen Q1 to Q3, and is growing, at less than desired rate of over 2%. We want something higher. But the message from here is that post-election year, the year after each election, election in 2011, we had a lower GDP in 2012. Election happened in 2015. We even had recession in 2016. Then election happened in 2019. We also have a recession in 2020. So post-election year is always more difficult years than the election year. That is what the data over the last 3 election season is telling us. Next slide, please. Then talking about the lending landscape, how do Nigeria borrow? Where do we borrow from? Who is borrowing? Who is lending? Of course, why 52% of Nigerians have had one form of access to lending or the other, 48% never even borrowed. Then this 48% that borrowed, unfortunately, 85, almost close to 6% of them borrow from family and friends. Only 14% have access to, 14% of the 52% that borrowed have access to financial institutions and some other formal channels of borrowing, and this is not this is not where we should be. Of course, in the following slide, we'll be able to show us where other countries are as far as borrowing is concerned. Then the next chart there, still on the same slide, the next chart there we see the gap between lending and maximum lending rates. Maximum lending rate has this week is as high as 29.5%, which is very high. And you see the gap between prime lending rate and maximum lending rate. And with the MPR, monetary policy rate, at 17%, the maximum lending rate can only be higher. And when this lending rate is as high as it is, what happens to borrowing? Because the cost of borrowing is high, and that is a disincentive to users of capital to make money. Credit to private sector, we've seen as a percentage of GDP for Nigeria is quite low, at average of 10% over the year. Sub-Saharan Africa, well over 30%, about 30%. Then the world, of course, over 120%. That shows that Nigeria is lagging behind Sub-Saharan Africa, the region where we believe we are the giant of Africa, and by population, by GDP size. By the world, of course, we're falling far below the trend. And the message here again, of course, there's information from World Bank which shows that credit penetration, lending penetration, were also very low. At about 7% of all adults, 7% of Nigerian adults have access to credit. For Sub-Saharan Africa, about 20%, and for the world, the advanced nation, is about 65% on the average. So all of this shows how collaborate the story or the information we have from the CEO of Credit Registry, that we have made progress, but we're not where we should be. And the next slide is quite eloquent about this fact. Next slide, please. So according to data or information from EFINA is reputed for their work in financial inclusion and supporting CBN in this initiative. Over the years from 2024 till date, we've seen that a lot of Nigerians have been pulled out from not being included in the financial space. You know, the excluded is reducing. I think excluded Nigerians from the financial space is about 30-something%, about 36%. Currently, it used to be well over 50%, you know, about 15 years ago, in 2008. No, but this progress so far, we are not where we should be. Look at the chart below, where we just compare Nigeria with some selected African countries. Look at Rwanda, just 7% are excluded, but Nigeria will still have over 30%. No, there is no need to be so much worried about this. We've shown that we've made progress, but we are not where we should be comparatively with African countries and the world. You know, for us, this presents opportunity that we still have a lot of space to grow and improve as far as debt market is concerned, lending space is concerned, and if we get to do what we need to do. And thank God this is election year, and we can only expect something better post-election. Next slide, please. You know, so like I said, over the years, we've made a lot of progress, the game changers. You know, why have we made the progress we saw as far as, according to FINA, you know, the microfinance framework, you know, CBN did a good job on that, tried to ensure that at least we have a different scale, you know, where people can borrow. You know, with microfinance framework, the criteria of borrowing from the formal lending environment, the bank is a bit moderated. The consumer protection framework also try to protect borrowers, you know, from all sorts of borrowing issues. The Credit Reporting Act, of course, made it easier to report credit, and that is the environment that Credit Registry and some other credit bureau are operating today. The National Collateral Act enhances the collateral space, where it's not only about real estate, your houses and the land tenure issue, but movable asset can now be used for as collateral for borrowing. Loan to deposit ratio, we've seen great work. As of 2019, I think around November, CBN moved the loan to deposit ratio from 55% to 70%, which means if banks have deposit of 100 naira, out of that 70 naira must go to must be lent, must be given to people that need this capital, either to do business or some other purposes, you know, to ensure the economy, especially the real sector, grow. So we give CBN the kudos for all the job they've been doing. Then the establishment of regulatory sandboxes. By sandboxes here, we mean trying to add or include some other players, you know, the fintech and some other operators, you know. We've seen a lot of flexibility in recent times from CBN trying to include other alternative platforms in this lending space. And this is also encouraging. Next slide, please. Okay, so by the way, I've explained this slide. You know, of course, Nigerians need money. We're enterprising, but 54% of Nigerians are at the productive age with good ideas, but access to credit remains an issue. And this is an area all of us need to work on and explore. It's no news that banks continue to lag behind for so many reasons. Probably not they're making, you know, business environment issue, but we've seen fintech and technology platform, you know, trying to compete in that space. And this is also important that we recognize that. I've mentioned about regulatory reforms by CBN that is trying to aid this market. And also, we've seen a lot of inflows of capital, fresh capital into Sub-Saharan Africa, especially in the fintech space. You know, they are not just enabling this space, but they are also beneficiaries of lending. Having said that, it's important to look at what happens in the election year or post-election year. Next slide. Next slide, please. So 2023 is election year. Next slide. Okay, the slide is not coming up, but this year is election year, and there are a lot of questions about what are the prospects of this economy, what are the prospects of the lending market. And as far as we're concerned, and like I have shown in the charts, over the last 3 election cycles, we've seen strong GDP, and all the forecasts we've seen by both analysts, domestic analysts, international analysts, all the publications shows that GDP will be strong or stronger in 2023. And conventionally, theoretically, when real economy or real output is stronger, of course, credit markets will naturally follow suit. You know, we believe that in this year and following year, the technology will play a lot of roles. You know, ability to analyze credit in such a way that you reduce human interface, you know, artificial intelligence. These are already happening, but it can only be more, you know, where credit analysis will not just look at the history, but behavioral, you know, algorithm and machine learning, you know, all our, can I say, all our activities, you know, being able to analyze it, and a process of getting this loan is faster and less of human intervention or fiscal intervention. CBN financial inclusion will continue to spur different, it will continue to support this market. You know, the cashless policy, you know, the new Naira note and everything, everybody's tilting towards technology, you know, and virtual operation. We believe that some of these things CBN is doing will continue to improve financial inclusion. And by the time more people come into the financial space, the lending market can only respond positively. You know, we are reserved about the huge deficit in the 2023 budget, about 11 trillion. You know, this will further put pressure on in the lending space, and potentially crowding out the private sector. You know, but this is the trend we've seen over the years, and we believe that economic policy agents will look at how to moderate this spillover effect that is expected in 2023. You know, securitization of consumer lending, of course, consumer lending is growing. We believe that this market needs to be organized and reorganized such that we standardize it, make it more fungible, you know, and introduce some secondary market around that. That will deepen that market. And just to conclude on this slide, there are some aspects that we are not looking at that is even deeper and stronger than the formal lending we've seen. You know, the buy now pay later is growing about $350 million in 2022. You know, by 2020 it is expected that it's going to be about 1.2 billion US dollars. You know, so, and this is the relationship between B2B or B2C. You know, where a third party is financing. We need to bring up this potential and see how we can reorganize it and clean it up, because it's actually growing. But bigger than that is the trade credit. You know, especially in the FMCG space, you know, fast-moving consumer goods space. You know, in 2022, about 20 billion, it's a $20 billion US dollar market. You know, and 15% of this was 15% of this number was as a result of loan given as trade credit. 0% from the is it the distributors or the companies to their distributors. You know, and according to information, this environment or this loan was able to have a multiple of between 300 to 500 turnover. You know, the FMCG's operators have used trade credit to boost their, can I say, their market revenue, turnover, and sales. And this is what we also need to look at and see how we can bring them and reorganize that market to make it to deepen it, because according to World Bank report, the players in that space, a little bit shadow, even far more in terms of the number compared to the people that borrow money from formal financial space. We're also seeing a lot of attention being given by DFIs, the UNDPs, moving money to one channel or the other to the economy through SMEs. So all of this need to be reorganized a bit more, and we believe that institutions such as the Credit Bureau should look at that and see how we can clean that up. But 2023 and beyond presents an interesting year. No matter what happens, we are going to see the next slide. No matter what happens, we're going to see investor confidence return probably in the second half of the year. Of course, naturally, during election year, you see a lot of people sitting at the fence, taking a flight to safety. So depending on the policy of the new administration that will come in first week of June. I say first week of June because on May 29, we swear in the president, then we also have to wait for the legislatures to, I think around June 7 or June 9. So by June, middle of June, we have a full new administration, and we expect market-led policy, and this will spur economic activity with a positive spillover on the credit market. So key responsibilities of stakeholders, especially the federal government, will be to improve ease of doing business, because by the time you improve ease of doing business, reduce the challenges in the business environment, the security issues, the energy crisis, fuel scarcity, logistic issues. Of course, naturally, businesses will expand and they will look for money. They will look for money. Like I said before, we need to make this market a bit cleaner, more organized through securitization and bringing in some other areas that we are not looking at, such as trade credit and pay now, buy now, pay later framework. And just to conclude, the customers, because I know in this call we have a lot of customers that are looking to borrow, they borrow. We need to increase transparency, paying back, and ensure that we have a cleaner credit history. This makes it possible and easier for us to get this loan and move this market further. We want to at least hit a level where credit penetration in Nigeria will at least be at par with other African countries at 20%, maybe in 2025. Thank you very much for inviting us. And just to conclude, the next two slides is about FMDQ. That FMDQ is an African first vertically integrated financial market. Through our subsidiaries, the FMDQ Exchange, the FMDQ Clear, FMDQ Depository, FMDQ Private Markets, the IQS, were able to support the lending market, the credit market, and ensure that securities transaction, both the trade, post-trade, are executed in a transparent, efficient manner. So our work in the market also deepens this credit market we are discussing today. Thank you for inviting us, and I will be ready to take questions as we move forward.
Thank you, Dr. Vincent, for that presentation. One thing that stood out very obviously in your presentation is the fact that we have made significant progress as a nation, but we are not where we're supposed to be. So I have a couple of questions for you here, sir. So let me start with this first one. So someone is asking, with our national credits rating at B- right now, okay, what do you think is the way out of this worrisome illiquid situation we have as a nation? I wanted to also ask, what should Nigerians expect after election, but you have answered that in the course of your presentation. About a part B of the first question as well. Most people on the streets don't know the impact of our national debts on them. So how does the national debt affect the average Nigerian on the streets? As Dr. Vincent is answering these questions, everyone all participants, should you have any question you want him to answer, please feel free and drop the question on the Q&A box. Over to you, Dr. Vincent.
Okay, thank you, Vera. Interesting questions. The first question is about our national credit rating at B-. What is the way up as far as this is concerned? I think November last year, 2022, the Fitch rating and Standard & Poor's downgraded Nigeria from B to B minus with stable outlook. In fact, I think one even gave us a negative outlook. This is not a good news for us because, of course, naturally, capital, especially international capital, want to flow into not just to environment where we have a higher rate of returns, but also stable economy. But the question here is, what is the way out? These rating organizations clearly outlined the reasons why we were downgraded. And part of them is costs and revenue. Our revenue sources, key revenue sources, have been threatened, especially revenue from oil, sale of crude oil. The number of barrels dropped in September 2022 to as low as 1.2 million barrels. Far below the OPEC quota given to us. At the period where oil price was high, so we're not reaping the reward. The benefit from the high oil price regime. That was one worry that they escalated in that report in November. Another one is a high cost of debt, debt repayment against our revenue. While our revenue was dropping as a country, at some point we were spending upon this 65% and 70% of total revenue to debt servicing and foreign currency liquidity issues, where investors are not able to move out their money when they want to move it out as seamless as possible, and a whole lot of other factors. So the question is, how do we get out of this problem? How to get out of this problem is to resolve some of these concerns they raised. And I'm happy that government is already taking steps around that, the oil theft being addressed. As of January, I think, or December, the production have just moved from 1.2 in September to 1.4 million barrels per day. And if the effort in that direction continues to progress, it can only be better. And by the time the quantity or the output of crude oil increases, our receipt from oil sale will always will respond, and that will also increase our revenue. And we believe that if this trend continues, by mid-year 2023, the rating will improve, probably going back from B minus to B plus or something better. And I also believe that one other thing we need to do will be to look at our borrowing, restructure our current debt. I think our current debt portfolio is 44.6 trillion, foreign aspect of it is over 17 billion, and the domestic about 23 point something billion US dollars. We need to restructure, especially our foreign debt, and to see how we can reduce the cost, especially the interest. By the time we do that, do something about our revenue and do something about our costs, our credit will improve. And when our credit rating improves, of course, FPI portfolio investors will come back, or they will increase, and we know the implication of this on our reserves, our exchange rate, and inflation. All of them will respond immediately. The other question you asked is about what we're expecting post in an election year. Generally, economic activities in an election year is not as vibrant, because somebody said that leadership will normally, there's a trade-off between governance and electioneering campaign. But thank God that the current administration is not the one. This is a brand new change of government. So we're not seeing that so much as far as this election cycle is concerned. The election will come and go in February and March for the state level election in early March. And in May and June, we're going to have a new administration across the country. So it's a year that we are going to experience something like one fiscal year, but two different economic season, a period of low, a period of slower really economic activities, and a period during which, especially from Q3 2023, where the new administration will start rolling out their market-led policies. With that, investor confidence will come back or will improve, and economic activities will respond. So as far as projections for this year is, we are going to experience a stronger economic growth in 2023. But like my presentation showed, that over the last 3 election cycles, we have had stronger economic growth in the election year compared to the post-election year. And this is what we believe would be different this time. We will be looking at a stronger economic growth even in 2024, as against the trend we've seen over the last 12 years. I can't remember the other question. Is about how does the national debt affect the average Nigerian on the street? When your father is owing and is paying a lot of interest and you don't have so much money to address infrastructure, address other things you need to address, of course, it affects the ordinary man on the street. But just to relate it, the debt service to revenue of Nigeria is about 60, no strong figure, but it's significant at over 60%. Total revenue, we are using that to pay interest and part of debts that are due. That is high. So we are left with about 40% or less to pay salaries, address our infrastructure concerns. And these are the reasons why we are going to borrow, at least to show up this. So how it affects the man on the street is that we are going to buy goods and services at a higher rate. Inflation will continue, and at the end of the day, you are not getting the type of support you need to get. As inflation progresses, government is not able to increase or match up with salaries, and same thing with private sector. Private sector are laying off, real wealth. Real wealth is dropping. The ability of household to go to market and buy what they need to buy will continue to drop. So something needs to happen. The man on the street will not say, no, it's their business. If they like, they can keep on borrowing. Somehow it gets back to you. And all the money they are borrowing, if they are borrowing to build infrastructure, there is no problem about that. It is not a sin to borrow. Every economy borrow. The only concern is if we are borrowing to use part of this to pay back what we have borrowed before, or service loan, or consume. But when we are borrowing to build infrastructure, we can never get it wrong. So the message here is borrow as a country and build infrastructure. And through this, we are able to pay back this loan with less pain. Hello, Vera, can you hear me?
All right, Dr. Vincent. Yes, I could hear you. So thank you so much. We've come to the end of your presentation, Doctor. Thank you. I can see a couple of questions. Please, can you drop your questions on the Q&A box? If it's not on the Q&A box, I may not be able to scroll through all the chats to get to the questions. So thank you very much, Dr. Vincent. So just hold on, we'll have a panel session. So we're going to be inviting you over to the panel session. So thank you, sir. Ladies and gentlemen, I'm delighted to introduce to us the third speaker. So the next speaker we have is Mr. Abiodun Keribe. He is the MD CEO, Afro Invest Research and Consulting. Prior to joining Afro Invest, he works with Tokyo Holdings and Elixir Investment Partners. Mr. Abiodun led investment and economic research teams at both Investment One Services and Meristem Limited at different times. He is a graduate of accounting from the University of Lagos. He holds an MBA in specialty in AI and future of automation and a diploma in computer engineering and business administration. He is a fellow chartered accountant and an associate member of the Chartered Institutes for Securities and Investment. Mr. Abiodun's presentation is going to provide a lot more insight on macroeconomic trends in 2022. So, Mr. Abiodun, over to you, sir.
All right, all right. Thank you, Vera. Good morning. I think it's still a good time to say good morning. Thank you so much for providing this platform. Thank you to Dr. Jamila. Thank you to the entire team at Credit Registry. On behalf of the board management and staff of AfriInvest, we also say thank you for this opportunity. My presentation also somewhat sort of focus on the macroeconomic environment in 2022, and I also would be trying to make meaning of what 2023 most likely would look like for the overall economy, and perhaps make some sense of it in terms of how it would affect credits and credit performance generally. That said, the presentation is somewhat split into about 4 core sections. The 4 core sections, the first part talks about the macroeconomic environment. The second part looks at the fiscal environment. The third part looks at what 2023 holds. And the last section looks at the credit environment. But before I take a deep dive into the presentation, let me just take a bit of a moment to provide some global macro context to this conversation or this discussion today. If you perhaps might recall, coming into 2022, there was somewhat high optimism for the global economy. And that high optimism was driven by the fact that in 2021, global economy recorded very strong growth in excess of 4%, just signaling that the world was able to break off from the impact of the COVID pandemic. And that then sort of formed a positive bedrock that 2022 was going to be another fantastic, great year. However, there were a couple of events that sort of then began to happen, and that series of events then changed the entire perceived trajectory for 2022. Top of that event, if you recall, was that we all slept, woke up in February, and from nowhere we heard that Ukraine was being invaded by Russia. That singular event also then kickstarted a whole lot of other connected events that then pushed the global economy into a point where everybody started to see inflation numbers rising quite significantly. That wasn't even the only factor that drove inflation, right? Before then, in 2020, there was this massive release of stimulus, monetary easing, reduction in interest rates, quantitative easing, pumped into the global economy to sort of ease the impact of the pandemic on the lives of, the average human. Now, all of these monies were out there chasing asset prices and pushing or pumping asset prices way up. So that layered with the fact that Ukraine was invaded by Russia and how that affected global supply chain, affected global trade. And the fact that China was still dealing with COVID, there were levels of restrictions that was imposed in China. All of that then formed that perfect inflation cocktail, which the world grappled with. From a 3.3% inflation in 2021, inflation more than doubled in 2022 to over 6%. Now, that then put global economic managers, particularly central banks, under massive pressure in terms of how do we then begin to look at how to curtail inflation. And then what then did they do? They began to increase interest rates. Now, the fact they were increasing interest rates then began to put pressure on global growth for 2022 or in 2022. That pressure took the shape of, there was some sort of loss of jobs. If you look at the US, job data in the US began to weaken, right? Consumer spending began to weaken. Cost of living was rising significantly. All of these factors put together then affected growth performance for 2022. And that's from a global perspective. Now, bringing this down to Nigeria, again, before I move into Nigeria, one thing I should say is that what I thought to provide that global context is that whatever happens globally has a way of impacting on emerging and frontier markets significantly, whether it's in terms of interest rates direction, inflation direction, economic performance. It has major impact on emerging market, particularly in terms of funds flow, how funds are flowing, how commodity prices are being shaped up. These are some of the ways how global economy affects emerging and frontier market, of which Nigeria is one of them. Now, coming into 2022 for Nigeria, then I'll be moving on to the next slide, which looks at the macroeconomic environment in 2022. Now, we saw that the non-oil sector practically supported the fragile growth we saw in 2022. Now, coming from 2021, Nigeria's GDP expanded by 3.4%, of course, supported by non-oil sector. And in 2023, that GDP performance is expected to have moderated to 3.3%, lower than what we saw in 2021. And that growth momentum, you know, if you look at it on a quarterly basis, for Q3 2022, it weakened significantly to 2.3%, from 3% in Q1, 4% in Q2 of 2022. In fact, compare the 2.3% we saw in Q3 2022 with what we saw Q3 2021, 4%, that shows you how significantly weak macro fundamentals, monetary policy tightenings, which took center stage, how it has impacted on the Nigerian GDP. Now, we sort of expect that for 2022, looking at how Q1 and Q2 has shaped up 3%, 4%, and then the fact that Q3 was weaker at 2.3%, and usually Q4 GDP is always somewhat historically stronger because of the fact that activities always sort of pick up in Q4, perhaps driven by all of the Yuletide events and year-end activities you have. But for 2022, we sort of think that might weaken. And that's why full year GDP performance for 2022 is estimated at 3.2%, driven mainly by the non-oil sector. Of course, like I earlier mentioned, monetary tightening was very aggressive. Inflation moved to very aggressive levels. Negative socioeconomic and environmental factors are the key downsides to this projection for 2022. That if you look at the GDP composition in terms of oil and non-oil sector or contribution, you realize that the non-oil sector is basically the biggest driver of Nigeria's GDP, contributing as of 2022, we expect it to have contributed about 93.8%, which is whopping, up from 91.8% in 2020. And that speaks a lot of volume for the oil sector, which typically its contribution is weakling, contracted from 8.2% in 2020 to 6.2% in 2022. Now, the question is why are we seeing that contraction? Why is non-oil increasingly taking up a larger share of contribution in terms of GDP performance? The fact is, the oil sector continues to suffer from history, legacy issues, such as suboptimal oil production. We have large-scale oil theft, low investment in the oil sector. These are major issues that drag the oil performance in 2022 to about contraction of 22.7% aside 9 months. And that clearly stretches the poor performance of that sector for about 10 quarters. So basically, the oil sector has been in recession. But mind you, that sector, even though it's been in recession for about 10 quarters, is still the largest contributor of FX earnings. So it still drives our FX earnings for the country, attracting as much as 45% of the overall FX that we earn. Nigeria basically earns FX from 3 sources: oil sale or crude oil, remittances, and suddenly the third one just jumped off my head. Now, if you look at the GDP performance also from the sectoral perspective, we realize that 3 core sectors: agriculture, industries, and services. Agriculture still remains the biggest contributor, right, or driver of that GDP, contributing about 25% of growth. However, its quarter-on-quarter growth trend is significantly weakening, right? From the chart up there, you could see that as at Q3, agriculture grew by about 1.3%, which even though it seems like a bit of a marginal improvement from Q2, however, it's a huge contraction from what we saw in Q3. Mind you, agriculture again is one of the largest sectors in terms of employment, in terms of job creation, perhaps account for about 45% of employment in the country. So a sector that is job elastic is now seeing very low single digit growth, while other sectors such as services that are not really job elastic are seeing double-digit growth. That speaks to the fact that Nigeria's GDP growth is also very imbalanced. Moving on to the next slide, like I touched on while speaking on the first slide, inflation has been one of the biggest factors that shaped up performance in 2022. Aside the fact that Russia-Ukraine global inflation was driving domestic inflation has actually been high for quite a while. So 2019, inflation had been in excess of about 11%. If you scale that way back, you see that number has been higher at some point. Now, the question is, why are we seeing this sort of high inflationary numbers in Nigeria? The factors are not far-fetched. Aside from the external shocks that I mentioned, Russia, Ukraine, global inflation, there are structural bottlenecks that continue to pressure inflation domestically. For instance, our major ports, right? There's still logistical bottlenecks around the major ports. We still have border closure that we're dealing with. Some of this, and then the fact that it's just we don't have fiscal prudency. We have very weak structural reforms so far over the past decade or more, continues to pressure inflation upward. And that trend is not likely to change significantly anytime soon. Now, for 2021, right? Inflation averaged about 17%. Now, for 2022, that average moved higher to 18.8. Now, at some point, November, October, inflation was about 20%. Headline inflation was around 20%. So by December, it moderated downward slightly. And like I said earlier, the biggest driver of inflation has been food inflation. We both understand that there are structural issues around food production in Nigeria. We've had insecurity, we've had cases of flooding, and of course, we're not able to produce as much food as demand is in the market. So these combined continue to pressure inflation higher. Now, what does inflation look like in 2023? So we sort of think, okay, somehow inflation will moderate marginally in 2023 to average 17.7%. Now, some of the reasons why we think this can happen is the fact that we think global inflation will moderate. Somehow, Ukraine-Russia tension would also somewhat moderate. But more specifically speaking, domestically, we don't expect a lot of FX issues or FX pressure anymore to also fuel inflation. Again, not a lot might change in terms of food and food production and some of the structural factors that affect food inflation specifically. But again, on an average basis, we think inflation will moderate in 2023. Now, moving on to the next slide, which looks at the external balance and then the capital importation, which also are very critical variables that affect GDP and affect the Nigerian economy. Market reforms clearly is the only way out. For our balance of payment statistics, right? There's been so much of weakness in terms of external data. If you look at the goods account, for instance, it is expected to recover in 2022. Goods account is expected to recover to about 8.9%. $8.9 billion, up from a negative of 3.2 in 2021, and even worse numbers if you look back as at 2020. Now, and this is, of course, driven by the fact that we saw higher crude oil prices in 2022, but not higher production. Now, for 2023 again, we expect that the goods account will begin to benefit from reduced FX outflow, driven by the fact that PMS importation will begin to moderate on the back of of the Dangote refinery coming on stream. The fact that remittances also should pick up. We have so many numbers of Nigerians that have jumped back over the last 12 to 24 months and even more. Now, all of these numbers, as far as they keep remitting, transfer accounts should look better. So that can support external balance in 2023. Now, political stability post 2020 election also is another variable that we think might support capital importation. For capital importation, for instance, right? FPI numbers have weakened significantly. We're seeing FPI number at 3.3%. As at 2019, right, FPI number was in excess of $16.3 billion. Now, what has changed? The fact that our FX policies over the last, since 2015 thereabout, have been so much zigzag, does not provide so much clarity and comfort for the market, has pressured foreign capital flows into the Nigerian economy, and that's why that continued to weaken. On the back of the fact that we likely might see a bit of lower pressure on the FX environment, we think that might improve marginally in 2023 from expected $3.3 billion in 2022 to about $4 billion in 2023. Now, moving on to the FX, that's the external reserve number or performance. Now, for 2022 was a year where there was an oil boom. However, Nigeria was without oil revenue. You and I both know some of the reasons why we have without oil revenues. So I wouldn't want to repeat those reasons anymore. But the key takeaway here is that it had a massive knock-on effect on exchange rates, right? 2022 was a year where some economies like Saudi Arabia, Angola, that are also key major crude oil exporters or producers, was seeing or recording surpluses. However, Nigeria was witnessing contraction and deficits. Now, that had major impact on the FX reserve, which moderated in 2022 when it should have been a bit of an aggression on reserve. Now, how does all of this come together to affect performance, the Nigerian economy performance in 2023? We sort of think that that for 2023, GDP growth is going to be weaker than we saw in 2022. We project it at 2.96% based on what our models are telling us, lower than what we've projected for 2022 at 3.2%. Now, and there are scenarios around this there. 3-case scenario, the optimistic case, the bear case, and of course the pessimistic case. I wouldn't want to bore so much with all of the scenarios, but on a very high level, real GDP growth is expected to somewhat be impacted by monetary tightening in 2023, right? Impacted by inflation and other structural inefficiencies across key sectors of the Nigerian economy. However, one of the positive catalysts might be the fact that we're able to begin to curb oil theft, and then oil production can also improve. Oil production in 2022 moderated or dropped significantly below 1 million barrels a day, when we have OPEC targets at around 1.6, 1.7 million barrels per day. If we're able to curb oil theft, and then the Dangote refinery also commences, that can also spur recovery in the oil sector, which would also positively impact on overall GDP growth. From here, I did dovetail into the fiscal environment. So in 2022, the budget the budget itself can be described as a budget of borrowing, in my own words, right? If you look at it in terms of revenue, actual revenue came in at 6.5%. If you prorate that, it's at 7.5%. And of course, the reason why revenue is weak are not far-fetched. If you relate the revenue number with the expenditure, at actual expenditure at 12.95. So revenue is just barely half of expenditure. That then means we'll be having about 6.4 trillion in borrowings, and which is what we've actually had in terms of actual borrowing. These numbers are as of November 2022. Now, what this means is that the budget or the government performance is basically being financed by a lot of borrowing, which is crowding out the private sector. And I will be moving into the next slide that also looks at how our debt profile has shaped up, perhaps since 1999 up to 2022. We can see that since 2014, total debt, which includes debt issued by the DMO through bonds, treasury bills, FGN debt, and also include the ways and means, which is the borrowings of the CBN to the federal government, has moved from 11.9 trillion naira to a whooping 67.8 trillion as of 9 months 2022. Now, that's about 5 times increase. Now, over that same 2014 to 2022 period, our revenue has moved or has grown by barely 80% from 3.7 trillion, right, in 2015 to about 6.5 trillion in 2022, 9 months, which is just roughly 2 times increase. Now, compare debt moving at 5 times or increasing at 5 times with revenue increasing at just 2 times. That gives you a bit of a perspective into how poorly our debt profile is looking and how much of pressure the economy is facing, which affects the government in terms of rating, affect corporate issuers or companies in terms of how they are also being rated. And in fact, dovetail into how credit performs, because when credit ratings begins to look poor, Dr. Vincent Elliott pointed out that Nigeria was downgraded. Clearly, it was downgraded in 2022. Now, that downgrade has a way of negatively affecting corporates, and if care is not taken, it could affect household lending also. Now, and these debt levels is clearly at the brink of the DMO's debt sustainability threshold of 40%. Looking at the next slide now, debt sustainability metrics, illiquidity closer than ever. Now, if you look at the total debt to GDP, the DMO has a threshold of 40%. We are currently at 32.5%. That means we are just getting closer to that brink. Now, what that means for us is we begin to look like a terrible nation that might not be able to remain liquid over a period of time. Now, if you look at also the debt, our revenue as a proportion of GDP, the revenue we're earning is just 3.7% of GDP, while total debt to GDP is 35.2%. That gives you a sense of how much pressure debt is putting on us. Now, away from just the debt, if you look at the debt service to revenue, we're using about 81% of our revenue, the 6.5 trillion naira of revenue that has actually been earned in 2022. 81% of that, roughly 81% of that has been used to service debt. While if you look at the external debt composition, external debt service to oil revenue, we are at 185% approximately. So that means our oil revenue, the revenue we're earning from just oil, alone, the sale of crude oil alone, is grossly insufficient to service external debt, which is a very critical indicator for credit rating organizations, and which is why Nigeria was downgraded in 2022. And this has a bad way of shaping up negatively for corporate issuer, for the credit environment, and in turn affects credit rating, which credit bureau agencies such as Credit Registry begins to then, poorly rate customers. Moving on to 2023 in terms of our proposed budget, claiming we are at a point where we're moving into the election cycle, right? So we see 2022 budget performance feel poorly weak, right? For 2023, the assumptions, some of them look quite interesting, some look highly unattainable. 1.69 million barrels average crude oil production assumption is the last time we did anything close to this was in December 2021. Since then, our crude oil production number has been roughly around 900 to 1.2 million barrels per day. Now, how are we able to achieve this in 2023? Are we able to achieve this in 2023? We're well aware that measures were put in place to curb oil theft, the large industrial scale oil theft we've been seeing, well, it's panning out for September, November. So oil production has picked up, but can it increase significantly to 1.69 million barrels a day? It looks highly unlikely. In terms of benchmark crude oil price, that number looks quite realistic in our view. Leading economists, leading agencies that make crude oil forecasts around the world are projected that crude oil for 2023 might just over around $80 to $90 a barrel. So for the budget to be predicated on the $75 per barrel looks realistic in our view. In terms of the exchange rate number, 435, we don't think that is very realistic. Even in the market, the CBN somewhat have tactically over the past couple of weeks into months began to close the gap between the I&E window rate and the parallel market rate, which means that the I&E window rate is tactically moving upward. So that FX assumption number might not be very achievable, but the average inflation rate looks realistic, very close to our own forecast of 17.7%. Then in terms of GDP growth, we think that number also is slightly a bit optimistic because of some of the factors that I already touched on. But if we look at the composition of the budget, the 2023 budget in itself, it looks more like another budget, unrealistic budget for borrowing for large deficit. Aggregate expenditure projected at 21.8 trillion is quite massive and huge. On the revenue side, 10.5 trillion revenue, that also looks quite massive and huge. If you put that into context, into how we've shaped up in 2022. As a 11 months 2022, just 6.5 trillion have been realized in terms of actual revenue. And that clearly shows a massive gap, which points to that number might be so unrealistic. Now, the composition of the aggregate revenue in itself, aside the non-oil tax revenue, which looks quite achievable at 2.4 trillion, because 2022 alone, non-oil tax was the only one that outperformed, driven by company income tax, value-added tax. Company income tax itself outperformed by about 58%, supported by all of the reforms put in place by the Federal Inland Revenue Service, introduction of technology and automating all of the tax process. And in case, again, that points to the fact that the business environment is somewhat doing fairly well, regardless of the macro challenges they're operating with. But for the oil and gas and mineral resources revenue at 2.3 trillion, that is grossly optimistic in our view. 2022, as at 11 months, we have barely done 500 billion, which is grossly below the projection for 2022 on its own. So that budget in itself suggests to us that those numbers are way out of league and looking more unrealistic. And what that means is that the deficit might be north of 12.5 trillion that's been projected realistically. Now, that said, we believe there are certain fiscal imperatives that must be put in place in 2023 as we move into an election year and we're looking to have a bit of a change in government. First of all is the fact that the public sector right-sizing and blockage of fiscal leakages would help in lowering the cost of governance. For instance, in itself, if you look at the employee or personnel costs in the government budget, it accounts for about 31%, which is quite massive. That's the second largest element in the government budget or in the government expenditure in 2022 after debt service. Now, that is, and then if you look at the proportion of employee in the FG, service, we're looking at roughly about 120,000 people compared to how many million people we have in Nigeria. So we're looking at 120K people accounting for about 31% of a 12 something expenditure budget, or 50% of revenue. Revenue for 2022 came in actually at 6.5%. 50% of that is about roughly 3.3 trillion naira. Now, that tells you that there's somewhat of an imbalance there. There's a need for right-sizing, blockage of fiscal leakages in the government. Secondly, complete removal of the petroleum subsidy would be a major positive for fiscal capacity. In 2022, over 5 trillion naira was expended by the FGN to subsidize petrol. Now imagine 5 trillion added to the 6.5 trillion in revenue that was earned. That comes to about 11 trillion. Now, that significantly will reduce the budget deficit and reduce the need for government to borrow. Now, I know a lot of Nigerians are always saying, oh, when they remove subsidy, that's the only thing the average man on the streets is benefiting. That's the only thing we'll benefit. How does it come back to us? How does the government go back to invest that subsidy element, that roughly 5 trillion naira that was expended in 2022 to subsidize PMS? How are they able to judiciously reinvest it in a way that it impacts on the lives of Nigeria? Even if they are not able to do that, but it grows up the number of revenue, reduces the amount of borrowing, it frees up fiscal capacity for the government, it frees up negative rating for the government, which affects corporate capacity, affects individual capacity. Secondly, is the fact that adoption of a holistic approach to solving insecurity challenges in the nation. Insecurity is having a major impact on agriculture, on key sectors, is having a major impact on even capital flows also. Foreign domestic investment has weakened significantly over the past 7-8 years, all because of insecurity. And then the formulation and implementation of compelling business-friendly policies would be a major catalyst for revenue growth and job creation. Lastly, part of the fiscal policy imperatives that we think is that the reversal of counterproductive land border closure, for instance, for essential goods that are not adequately produced, will be a key in reversing runaway inflationary trend. Moving on to the next section that looks at what does 2023 hold for us? First of all, there are major events that will shape up 2023. Two of them perhaps are already in motion, in swing. The first is the implementation of the new cashless policy. We saw how that initially, when that policy was made, how it affected the parallel market or the FX market, pushing FX rates, parallel market rate to as high as 850, 860 at some point. But since that policy began to seep in and the effect began the reality of the effect began to dawn on Nigerians, we've seen that that parallel market rate has moderated quite relatively and has been somewhat stable all through December. That policy will have far-reaching implications for the economy, support financial inclusion, and also support the efficacy of monetary policy. The next one is the general polls. The general polls, of course, the election comes with its own uncertainty, but again, is the fact that even when the elections are being concluded, just like we had in 2015, there might be a case that there's a bit of a break before cabinets are set up and all that, and the new administration get down to real business. It might take a bit of a while. Even if that does not happen, before the administration really settles down to really begin good work, that also might take a bit. Then the census is another thing, and the impact of the
Mr. Biodo, thank you so much. Because of working with time, trust me, if you leave me, I'll just get glued listening to you. There's so many questions there that I want you to answer, please. The interesting thing for me is, I don't know how we as a nation, we are very hopeful, very happy when we look at all the statistics about us as a nation. You did mention a lot of structural bottlenecks and inefficiencies. And I was just sitting here telling myself, I think I'm speaking on behalf of most millennials and Gen Zs that are here. We've heard about these structural inefficiencies and bottlenecks since birth. And we are very hopeful that we are going to begin to see a turnaround in our country. But I have a question here for you from a participant, an attendee, and I want you to answer this question. So everyone, I want to apologize. I had to cut and stop Mr. Biodo. We're going to share the link and his presentation to all of you. So someone is asking, why do you see removal of fuel subsidy as a pessimistic case driver, according to your presentation? And he said, would this not lead to a reduced government borrowing, and therefore the ability of banks to then provide credits to the private sector. And also, I also want to I want you to take this at the same time. Someone is asking, with the looming removal of subsidy on petroleum products, would you still stand by your projection of inflation in 2023 at 17%? Because you did talk about moderation of inflation in 2023. So over to you, Abiodun, to answer these questions. Thank you.
All right, thank you very much. So the removal of subsidy would clearly, right, initially have negative impact in terms of prices and inflationary pressure. And that's where, first of all, it looks like a negative for the economy. But in the long run, as the savings begins to accrue, just like I earlier said, and it begins to shore up government revenue, reduce fiscal exposure or budget deficit, the impact begins to now kick in. So on a balance of factors, it will have a positive impact. But if you look at it from a two-dimensional perspective, initially, you will see pressure, commodity prices, food prices, transportation. In fact, you might even see some sort of social unrest on the back of that policy. And that's why the current administration has somewhat pushed it into June, that, okay, June 2023, we'll look at removing subsidy, because they're praying that by then, they're no longer in administration and they don't want to face that backlash. So that's why it looks like a negative on one hand, then on the flip side, it then looks like a positive. But on the balance of factors, it will have a positive. Now, impact. And then that, I think that already speaks to inflationary pressure also on an average basis. So if you dimension the year into a first half, second year angle, first half, we will see somewhat of a bit of a moderation rather in inflation. And that moderation will be driven majorly by base year impact. And that's why you've seen December inflation had already started moderating, right? And that will most likely continue into March, April, and then from maybe May, June, July, you then begin, and then from till end of the year, if subsidy finally gets removed, inflation can then pressure upward. But if you take an average of those numbers, we sort of think it might close at around 17.7%, slightly lower than what we saw in 2018. So that's the backdrop for it. And again, to support this argument is the fact that we're moving into an election year. We have three leading contestants, three leading candidates, all of them with market-friendly reforms or market-friendly agenda. But the big question is, how are they likely to implement this agenda? For instance, someone says, oh, I want GDP to grow 7%. And then maybe 10% in the long run. How do you want to achieve it? Another person says, oh, I want Nigeria's manufacturing sector.
1 minute, okay. I hear you, Abiodun. I actually think that you've basically answered the two questions. Don't forget to have a panel session. A lot of us want to actually squeeze out all that you've got inside of you. So just hold on. So I have to move to the next speaker right now. So thank you so much, Sai. It was quite insightful hearing you. Thank you so much. I appreciate it.
Thank you.
So we want to move to the next speaker. Can we share the screen, please, for the next speaker while I introduce him? All right. All right, so ladies and gentlemen, apologies for that slight delay there. I'm delighted to introduce the next speaker to you, Mr. Kelvin Ugwoke. Mr. Kelvin is the ED, Executive Director, CRO of Fidelity Bank PLC. All right, he has over 32 years of experience. Apologies, I'm not controlling this. All right, thank you so much. So Mr. Kelvin has over 32 years of banking experience across banking operations, commercial banking, and all areas of risk management at strategic and operational level, credit risk market risks, operational risks, and compliance. Mr. Kelvin holds a bachelor's degree in civil engineering, first-class honors from the University of Nigeria, Nsukka. Actually, I paid attention, I emphasized first-class honors. And if you're here and you went to UNN, or you have a friend that went to UNN, you'll actually understand why I emphasize that. It's just like coming out of a school like University of Ibadan with a first class. So he also has an MBA with distinction from Edinburgh Business School of Harold Swartz University. He's a senior honorary member of the Chartered Institute of Bankers of Nigeria and a certified risk manager and the first vice president of the now Chartered Risk Management Institute of Nigeria. Mr. Kelvin is coming to talk to us from the lender's perspective. I want to also remind us that our topic today is on national credit insights, and we also look at our economic variables pre-2023 elections. So let's hear from an operator, an industry leader. Over to you, Mr. Kelvin.
Thank you very much, Vera. Thank you, Credit Registry. Thank you, Dr. Jamila, for inviting me to this session. And thank you to everyone who is also joining us to share in this moment. I think this is a very useful program, Market Pulse, at this auspicious time in our lives as a nation. So really, really good initiative. So I'm going to speak about elections and lending, and I'll be speaking from Fidelity Bank's perspective. I will end the session with looking at Fidelity Bank's perspective. Now, we know how elections hold. Nigeria, we're not new to it. Everything working well is supposed to be a time we choose our leaders, those we want to take us forward. And we typically do this every 4 years here. And there are times when there's a lot of activity in the economy, a lot going on, the campaigns are on, quite a lot of things happening, all focused on the election. So naturally, banks pay close attention to what's going on and try to craft responses that will at least position them well, regardless of the outcome of the elections. Next slide, please. So, what do we normally see around elections? By the way, I have 10 minutes for this session, so I'll try to be as fast as possible and just deliver the key things and then wait for the Q&A session. Now, what do we see around elections? Typically, there's heightened uncertainty. Number one, there's going to be political change, so that's clear. Definitely, that brings uncertainty. There's also talk of economic change, likelihood of economic change. You expect that things will change from what it is now to whatever the new person is going to bring on board. So that also creates uncertainty. Then for democracies like Nigeria, you have heightened security and social uncertainty. So those things, they're there. Then the other thing is there's a slowdown in economic activities. That's what usually happens up to election day, particularly with multinationals, those who want to invest in the country. The moment they see an election is coming, because of the heightened uncertainty, they are more likely to hold back and say, let's wait until we see the outcome of this election and know who's coming in, what are his policies, is he going to make some new things, are we going to be safe to? So that slows down economic activity, slows down investment into the country. And then we have another kind of japa, not from the youth now, I'm not talking of the youth japa, but more from those who have the means to leave the country and go stay somewhere they think it's safe and then wait for the outcome of the election. And this japa is frequently associated or accompanied with some capital flight. Money goes out to where people believe it's safer, temporarily, hopefully. And then after the election, when when there appears to be stability, you might see the money start coming back slowly. Next slide. I would also not forget to mention that, yes, there's also increased political spending. I need to talk about that. So you find that the slowdown in investment activities is somewhat offset by this. I'm talking of the typical election period now. I'll come back to speak about the 2023 election. So the slowdown in economic activities is typically offset by an increase in political spending. So you see a lot of cash moving around, and there's a chart I'll show briefly later that just talks about how much cash is spent usually around election periods. Okay, next slide. Let's go to the next slide. This is, I think we've talked around all this. Next slide. Okay, so let's look at 2023 elections now. I want to start with the hypothesis that this election is unique, kind of different from others. And one, from an economic perspective, a lot is happening that could change the way things turn out after the election and throughout 2023. And I think Mr. Abiodun spoke to it, and also Dr. Nwan, he also spoke to it. Quite a few things are happening that are like game changers. So that's number one. We are still recovering from COVID. We're not out fully from the impact of COVID, both globally, and the global slow recovery also is reflecting in Nigeria. And you can see that in 2022, the GDP growth, as Mr. Abiodun told us and Dr. Mwani told us, in 2022 was lower than what we had in prior years. So this is an economy that is still recovering from the impact of COVID. And there's a lot going on that further constrains economic growth in 2023. Then we have the Russian-Ukraine war, which is there and is the big overhang right now over the global economy. Kind of been, China's opening up. China recently decided to loosen the tightness that they had on COVID. So they lifted all those, they're lifting all those restrictions. In fact, they've lifted all of it. And that's expected to spur domestic demand in China. And that's significant for the world because of China's population, China's contribution to global economy. So if China is opening up, that could pull the rest of the world up as well. And we hope that helps to offset or balance out what Russia-Ukraine war is the effect of the Russian-Ukraine war. So that's one part playing, and that affects us somehow in Nigeria one way or the other. We've talked about the oil revenues, less than optimal oil revenues, despite rising oil prices. And Mr. Abiodun has spoken to that, so I will not repeat it. And then we have rising inflation and domestic interest rates. We've not had it as bad as this. Last year alone, 2022, the Central Bank of Nigeria increased the monetary policy rate by 600 basis points. That's significant in any economy. So that's where we are. And that's driving every other thing. The moment the CBN increases rates, naturally it makes banks like us, typical banks, we also want to reappraise at what rates are we lending? Can we absorb this increase? Do we pass it on to customers? How much can our customers absorb such rate increases? And so on and so forth. We go through various scenarios and sensitivity analysis to see where it plays out, and we make decisions based on that. So 2023 election is unique because of all of these things. Next slide, please. And we have the impact of the currency redesign. That's still going on and is very, very unique. And we talked about, normally by this time of the year when you have elections, politicians spend a lot of money. This year is different. There's no money to spend because the money is going back to the central bank and into the banking sector. So about $4.3 billion, that's about roughly just about 2 trillion naira or thereabout of money, of cash, has gone back to the central bank. And at the end of this whole exercise, about $6 billion equivalent will have gone back to the to CBN vault, and that's a significant. That's another significant factor in this election. Next slide. In election periods, how do banks typically react? Because of the changes that is as expected in the economy, because of the uncertainties around the election period, banks banks must react. Now, normally we are guided by the 5 C's, which I've listed: their character, collateral, and so on and so forth. In an election period, you can expect that conditions will change. The economic conditions will change. Capacity could also change because reduced spending power, or the impact of election period around spending power, around economic viability around that time, will affect capacities of borrowers. Collateral conditions will change as well. The value of collateral might change, and all of this could affect character. If things are not working well, that's when you test real character. So election periods kind of translate to increased credit risk for banks, and banks will react accordingly. Next slide, please. So in general, banks will extend credit. Banks have clearly defined policies for credit extension, all of these things here, which we've talked about. Now, if you look at 2022, and also from Dr. Wani's presentation, you will notice that there's something he said there, that credit to the private sector has always continued to rise, whether it was during elections or not or not. The question then is, why is that so? Why is that so? I think the opportunities in Nigeria are tremendous. That's what I would say. And somehow there's still so much room to grow. In his presentation, he talked about credit to the private sector at being just about 10% compared to 120% that you see in developed economies. So that speaks to the potential that still exists. So you find that regardless of how tight the economy might appear to be, banks have continued to do well, and there's still room for banks to do well. If you do your business well in a place like Nigeria, with opportunities here, you will generally do well. And through election periods, we've seen that that's the case. 2022, if you look across most of the banks, including Fidelity Bank, you will see that there's been some element of growth of the loan book across all sectors. And that speaks to the opportunity that still exists, regardless of the heightened risk from the elections. Bottom line is, regardless of the risk, you can still do business if you carefully structure whatever it is you're doing, your credit extension. You carefully structure it, and that's what banks generally do. Next slide, please. So election periods, apart from the general heightened credit risk, there are also risks that are political in nature, so banks pay more attention to that. Exposures to PEPs, you're very careful. You want to avoid obvious partisan lending. You must avoid those kind of things so that you don't get into the books with the regulators and enforcement agencies. And then you also are more careful with loans to state governments, where there will likely be a change in government, in whoever is leading the state. You want to be careful. So what has Fidelity Bank done in terms of preparing for 2023 election? Now, what we've done is really not different from what we always do, which is, number one, carefully look at the potentials of various sectors of the economy as might be impacted by the election, and then have a clear portfolio plan. Identify sectors that you want to play in, sectors that have potentials to do well, and those that may not do well. and then define clear limits of how much you want to extend loans to each of those sectors. So that's it. Then the next thing is very careful obligor selection. No matter how tough the environment is, if you know your customer and you're able to clearly structure a credit around for that customer, you will do well. Then, of course, be sensitive to the environment and all the changes going on in the environment. So that's what we have done in Fidelity Bank up until now. So 2022, that's leading up to the elections. That's what we've had to do. And we've also kind of prepared scenarios of what could play out after the election and how that might affect our business. And we've mapped out our strategies around possible scenarios. We've adopted what we think is the most likely scenario and then working around that. So what do we expect 2023 to be like? We expect the polls to go well. We expect to have successful elections, just like we've had in the past. It's not the first time we've had elections, and the issues leading up to this election, while they may be accentuated a bit, but they are not totally different from what we've had in the past. We've expected the new government to implement new policies to drive the economy in a new direction. All the leading candidates speak to that, so that's certain. We expect some form of global economic recovery, riding on growth in China. And that, I think that's already playing out in forecasts across the world, even though there were talk of recession, that's been moderated now. And so we expect that to be better. With CBN's monetary policy, what they are doing with this cash thing, we expect a faster pass-through of their policies. So that means they will be better able to manage inflation going forward. And that should be good for the economy generally. And finally, banks will certainly continue to support growth and continue to do well. Next slide. So banking is very good business. I like to end with this. If you don't do anything, don't. And I think banks in Nigeria have been able to continue to do just that. Thank you very much for listening. Thank you.
Thank you, Mr. Kelvin. Thank you so much. One thing that I took out from your presentation, which is quite significant for us in Nigeria, is the fact that 4.3 billion cash have gone back to the CBN. Wow. And I think we should applaud Buhari's administration for this policy, please. Just do it with your heart. So thank you. It's really a good one for us as a nation. So without much ado, I'll introduce the last speaker for today. So ladies and gentlemen, please meet the next speaker we have for today. We have Mr. Henry Obiako, the MD, CEO, Fair Money. Prior to joining Fair Money, he worked at Quest Advisory Services Limited. He also worked at Procter & Gamble Nigeria as an assistant brand manager, and also worked with Owando at some point in his career. Mr. Henry is a graduate of industrial chemistry from Delta State University, and he holds an MBA from Lagos State Business School. He is passionate about supporting entrepreneurs to grow their businesses, because we know we have a lot of entrepreneurs here that will be asking me for your contact after today. So Mr. Henry, over to you. You have the floor. Thank you, sir.
Thank you very much, Vera, and good afternoon to everyone. If you can hear me clearly, can anybody just drop a note on the chat box to say yes?
Yeah.
Perfect. Thank you so much. Right. So thanks again, Vera, and thanks to the Credit Registry team for the invitation. We at Fair Money are happy to be your partners and to be here to provide some context regarding the ongoing conversation. Right. So just for to provide the background, I have been told that we have 10 minutes and I will try to stick to it. I also was told that we should talk about the experience for 2022 that Fair Money had, and more or less how that impacts generally the digital banks and the fintech players that are involved in digital lending. Quick background for Fair Money. Fair Money is a company that was started or set up in 2017. Of operations commenced fully in 2018. We're a credit-led digital bank. And so generally what we did when we started was look at the opportunities that we saw in the markets. A lot of people have talked about financial inclusion and the huge gap in accessing financial services. And so we looked at it, and this is why the founders set up the business. We also looked at the major pain points for consumers, right? And pain point number one for consumers really is access to credit. And so for us, that was our go-to-market strategy. We looked at the market, and we saw that a lot of consumers could not access credit, could not get credit from your traditional commercial banks because the requirements were a bit more stringent. We saw that gap, and we thought to come in and play in there. And there are quite a number of players here that have identified it and are trying to continue to tap into it and play a role in increasing financial inclusion in Nigeria and in Africa as a whole. So 2022 was an interesting year for businesses across the world. Just like Mr. Abiodun said earlier, one of the early things that happened in 2022 was the Ukraine war, which had a rippling effect on a lot of items. And so what we saw was that energy prices continued to increase, and they increased significantly. Just like a few people have pointed out, unfortunately, Nigeria did not benefit from that energy prices, and really that's a topic for another day. The second thing that happened globally was the fact that we saw high inflation across all markets, across the US, the UK, or different areas within Europe. So we saw that, and then in response to that, central banks across the globe tried to use the different monetary policy tools to try to impact that. In Nigeria, this was not, we were not left out, all right? So we saw inflation rise to incredible highs, over 20% in 2020, right? And the response that we saw, just as Mr. Kevin mentioned, was we saw CBN increase rates multiple times, and this was after rates were stable for several years, right? And this has even continued in 2023 with the CBN increasing rates again just last week. Unfortunately, the impact for players like us is that we see the cost of funds increasing, right? And that begins to inform a decision to how do we manage that? Where are the other areas where we can cut costs to compensate for this increase in the cost of funds, or generally, are we able to translate or transfer these increases to the customers, which is not entirely easy to do, because the customers are also battling with a lot of things, i.e., reduced income, and then inflation. So this really was the context within which the players in Nigeria operated in 2022, right? And for digital people who are focused on digital lending, especially consumer lending, where we are focused, it was important for the players to do a few things. And we move on to the next slide. Right, the first thing that needed to happen, right, was to look at the systems that we had, look at the credit engine and credit algorithms that we have to become a bit more stringent in our criteria when accessing credit worthiness of customers. For companies like us that rely primarily on data, this is a bit critical because Mr. Kevin in his speech was talking about the 5 C's of credit and how the commercial banks use that in identifying or in their credit appraisal process. For us, it's more of looking at data of the customers and trying to use that to predict if the customer is a high risk customer or a low risk customer. So that's the first thing. So be a bit more stringent on your criteria for giving out loans, for determining the size of the loans you give out, and also determining the tenor of the loans that you give out. And when you do that, the second thing is to focus on the high quality customers, right? So because that's where the value is, or as at last year, that's where the value was. And for us, we think that even this year, it's going to even be more critical, right? So the high quality customers that have very low, have low risk profiles, but have needs for loans to be able to carry out their business or maybe some immediate issue that they need to sort out. And so for us, it's very, very critical to focus on those types of customers as we grow the business. Another thing that a few players had to grapple with and look at is, right, so because of the worsening macro conditions, right, what do you do with loans that are seemingly going bad? And so what can you do? How can you restructure some of these facilities, right, to ensure that you still are able to collect on these facilities, make it easier for the customers to repay, and then you keep them happy and keep yourself happy as you continue to grow your revenue. Another thing, I think a fourth thing that was very, very important and critical for players last year, and still remains critical, is how to diversify income from the customers that you have, and try to find other ways of generating revenues across different products, right? So looking at the depth of the products that you have and trying to see how you could expand that, either by looking at the tenor, right, or looking at the group of customers that you are lending to, trying to see if there are other types of products that you can develop. So for example, a few players got into BNPL, buy now pay later type arrangement. A few other players began to finance certain types of assets, mobile phones, and the likes, right? So for players, those things were important and critical to survive the macro headwinds that we saw last year and we continue to see this year. We at Fairmoney were able to use some of these concepts and philosophies in trying to keep the company thriving last year and growing, and so for us that will continue to be the way. Another thing to really mention here is in this type of environment, data is key, and partnership with, for example, with credit bureaus like CreditRegistry become very, very important. So there's the data itself, there's the quality of the data that is available from them. And so how are the different lenders within the the country able to provide information on their lending and how much it is that that they give out, and who is a quality borrower versus who is a high risk borrower. So using all that data points, it's important as digital players try to bridge that gap of access of financial services in Nigeria. Thank you very much, Vera, for your time. Over to you.
Thank you so much, Henry. Thank you so much, Henry, for keeping to time. So now we're going to the panel session. Henry, just one question kept nagging in my mind when you were talking, and I believe I'm thinking for ordinary Nigerians out there, because he kept mentioning high quality loan customers. Trust me, some people will be wondering, why has Fairmoney not been giving me loan? Why have they been discriminating against me? That's just on the light side, actually. So, but I'm interested, we're going to the panel session right now, and some of the questions there will give you the opportunity to actually address what I've just asked you now. So may I call on the speakers to just turn on your video? The person controlling the screen, can you just stop sharing your screen, please? All right, thank you so much. Thank you, everyone. So the first question I have here is for Dr. Wani. Dr. Wani, can you just say hello to us?
Hello, can you hear me?
Yes, you can. So the questions, all the panelists have just an average of 3 minutes to answer your questions. And for some of us that kept chatting when Dr. Abiodun and Mr. Abiodun and Dr. Wani was talking, please feel free and drop your questions on the Q&A. I'll try as much as I can to squeeze in your questions to the panelists to answer. So Dr. Wani, in 3 minutes, can you just let us know the impact of NPR and fuel scarcity? That is what is biting an average person on the street right now. So the impact of NPR and fuel scarcity on economic growth and productivity.
All right, thank you, Vera. The NPR, just like my co-presenters have mentioned during their various presentations, Kelvin spoke about that. I think Abiodun also did so mention the trajectory. In fact, according to Kelvin, he said that CBN have increased NPR 2022 by 600 basis points, which is quite unprecedented. The impact of this is that, of course, this is the benchmark interest rates that government, the meaning of that is that every other interest rate bears from this benchmark rate. Whether it is the cost of mortgage, whether it is the cost of borrowing from bank, whatever interest rate. And Nigerians are already borrowing at ridiculous interest rates. Maximum lending rate from commercial banks at 29.4%. If you now go into SMEs, some of them, they buy now, pay later, charge as much as 20% on monthly basis. Some charge 5%, the microfinance bank, 5%, 6% on monthly basis. And unless that, you're going to be getting 60%, 72%. This is huge. So at 17% NPR from what it used to be, these rates I've just mentioned will naturally rise. So we're going to see more defaults, more challenges in picking up this loan, even if it's available. Borrowers will look at the economic the efficiency. How much am I going to make from being hit by high interest rates, inflation, exchange rate, and all of those things before you can go and borrow. So this affects the lending market, the lending space negatively. That is just the implication for everybody, and for few that will be able to borrow at an elevated interest rate as a result of this NPR. Naturally, it has to be charged to the selling price of the goods and services. you know, and customers will finally bear a brunt. But you can be able to transfer these prices as much as you can, depending on where you play in the economy. You know, if you are playing in a product or services which demand is inelastic, fine. Maybe you're into petrol or fuel. You know, you must demand for it, whether you like it or not. You know, even if you reduce the rate of demand, but you must. So the commodity or the service is inelastic. But if it is elastic, which means the little increase in the price of that service or services or product will drive customers almost away, you will likely internalize such increases in prices or even close shop or begin to operate marginally. So at the end of the day, the real output in the economy will be affected. Unemployment will likely be adjusted, unfortunately. And if unemployment is adjusted, you know that government revenue, something will still happen to you now. We'll be talking about government revenue. Where do government get this money? Not only selling crude oil, you know, people have to pay taxes. You know, if you consume more, you pay VAT. If you earn more, you pay PE and all those. So it's the whole economy will have been impacted, and something just needs to happen, you know.
All right, thank you, Dr. Vincent, for that. The next question is for you, Abiodun. Mr. Abiodun, can you just say hello to us?
Hello.
All right, okay. So, Mr. Abiodun, I have two questions for you. Okay, so I'm going to allow you to answer them in about 6 minutes. So, the first is given the inflow of from service sector, right? And this basically compensates for the balance of trade right now in Nigeria. And your presentation, Abiodun, has shown a contraction in the oil price contribution to the GDP and growth in the non-oil sector. So my question really is, I'm just curious, is our market efficiently incorporating this information, especially when it comes to inflow from service, right, from service sector? And the second question for you. So we are aware of increased NPR in 2002, okay, to 16.5% from 11.5. Do you see a possible downward review in 2023 by CBN? And if there is, people will be very curious to know because they are all beaten by high lending rates. So if you see a downward review by CBN, do you think financial institutions will actually reduce their lending rate as a result of this? Over to you, sir.
All right, thank you for those very brilliant and complex questions. I'll take it from the very last one. What do I think the CBN or the MPC committee will do with respect to the benchmark lending rate in 2023? I mean, for instance, to start with, January, there's been a 100 basis points increase. So it has moved from 16.5 to 17.5. Now, based on our model and our assumptions, we think there is a maximum window for the CBN of the MPC to increase interest rate. And with that window is about 250 basis points. So already they've done 100 basis points. So there's still a window for them to do another 150 basis points. Now, anything above that will significantly hurt the economy in terms of growth, in terms of credit pricing, in terms of mortgage pricing, in terms of basically every other thing is going to stall growth and economy will contract. So yes, indeed, we think the pressure points are there. The CBN will likely not, bring down the NPR this year. Worst case scenario, if they max out that 250 basis point window, the rest we'll see for the end of the year is a look and hold position, which is they just sit and hold, right? And really, that's the view. So I don't think they're going to bring the NPR. So I wouldn't be talking about why they likely will bring down NPR. But again, maybe we should just talk about it for the sake of learning. Yes, if economic growth begins to advance very aggressively, inflation begins to moderate significantly. And then if the external environment, conditions in the external environment improves, US labor market improves, global inflation moderates, central banks globally begin to reduce interest rates, then there might be a need for the CBN to cut NPR, but the likelihood of that is super slim, super slim. Now, coming back to the question The first question around the external balance of payment and capital importation, and if that makes any meaning for the service sector or the industrial sector. Candidly, those two sectors, because of the way they are structured, particularly the service sector, and if you look at the leading subsectors in that sector, telecoms, ICT, financial services, including the banks, insurance, these guys are operating with somewhat very interesting business model that regardless of how the economy is shaping up in terms of challenges, they're able to deliver very impressive performance. And that's because, say, if you look at it from a demand supply perspective, the services they provide, regardless of what the economy is, you're compelled to use those services. Is the ICT related services? This conversation is happening today because of ICTs. So no matter what happens to FX, no matter what happens in the external environment, those subsectors will continue to deliver good performances. And that's well mirrored in terms of the GDP performance. Now, the major issue is on the manufacturing sector, which continues to suffer from years of FX policy somersault, inconsistent policy around FX management, lack of ability of, the key regulator to communicate steady, stable policy that will instill confidence in the minds of the market. And the manufacturing sector is suffering from this year in, year out. I fear I may not have dimensioned that question well because I may have lost scope of it. Perhaps you want to repeat the question again. Vera, can anyone hear me? Oh, can anyone hear me?
Yes, we can hear you.
Okay, can hear
okay.
me. Okay,
Yes, we can hear you.
Because the network is. So thank you. All right, so thank you, Mr. Abiodo. So allow me to ask the next question to Mr. Henry. So Henry, there are a couple of questions out here for you. So I would like you to answer them one after the other. So the first question is, one is asking, with the new cashless policy, fintechs are in for a free ride, right? So what are some of the risks that they will consider besides the normal risks of credit default? Then the second question is, there are three of them actually. I'll just ask the 4 questions. I will now allow you to answer them in 5 minutes. The next question is, which lender use data to target the better individual risks and proactively offer credit to them? Then the other question, someone is asking, Fair Money, what were the adjustments specifically that you made to identify low-risk borrowers? What specific changes in the algorithm? Where do you see high growth opportunities in fintech? And what key impacts do you think the entry of PSBs in the Nigerian market will have on your business? So Henry, you can answer these 3 questions. They're actually on the Q&A. So you can just look at it at the Q&A and answer. Over to you, Henry.
Thank you very much, Vera. It's a very interesting questions. I think so for the cashless policy, I think my view is that number one, right, it's a benefit for digital players and fintechs, and really the financial services sector, wherein there's a lot of focus to powering transactions online and online, right? And so what you will see is more transactions going through online means and through digital means, which may result in better business for the players that have been set up that way. From a point of view of the impact on lending or defaults, I don't think that those two are connected. In fact, on the flip side, for companies like us, wherein the business is totally digital, it is even a plus for us. So customers are able to repay us even better. The infrastructure for them to repay us is smoother and seamless, right? So from that point of view, I don't see I think it's actually a plus, right, for us in terms of repayments and in terms of the impact on defaults, for instance. So that's one. On the question around which companies are using data to determine who to lend to, I would say, as it is, nearly everybody is doing that. So even the commercial banks, where like Mr. Kevin's Fidelity, they would rely on data to provide some lending services. Most banks now have USSD products for their customers, and that really is dependent on the data they have on their customers, right? So nearly everybody's doing it. I guess the difference is as to what skill and what you rely on, what data access you have, and what data points mean more to you, and more or less the scope. So, for example, the commercial banks may only rely on their proprietary data relating to the customers' transactions within their bank alone, right? While some other players may also look at other things, mobile spend, data spend, and certain other data points. So it's the scope is quite broad, and a lot of players are using it. So I don't think I can begin to mention specifically people that are doing that, but generally all the banks, all the fintechs are using data to make some lending decisions. The scope is what varies. The third question, which is a major question, was asking specifically what changes in our algorithm that we made to help. So with all due respect, if I'm answering this question here, that means that you don't want me to have a job any longer, right? But I think conceptually, right, it's important to sit down and look at again, back to data, because this is what we use. So what are the data sets that are very important for your business in making a decision? And this is important whether you're in the lending business or you're in some other business. So for us, I'll give you an example. Data that we get from credit bureaus such as Credit Registry, right? We've seen a high correlation with the data that we get from credit bureaus to the quality of the customers, right? So that's one important data point for us, right? And so in cases where in cases like last year, where macro became crazy, and then you see that maybe the risk with customers is increasing, you now sort of like look at those key points, the key data points, and in this case, for example, the credit bureau data, right, and more or less lay more emphasis on that data. The challenge, right, I would say maybe with that is for players like us, when we started the business and we started borrowing and giving out loans, right, there was 50% of the time you did not have information about the customers, right? So they were not on any credit bureau, right? So it's more or less the first time they were getting loans from a formal organization, right? So in that case, you had to rely on other data points and try to make a decision on whether to give a loan or not, or how much to give, right? But in cases like this, where macro is crazy, risk is heightened, you want to now go back to it and rely on place more emphasis, for example, on credit bureaus. So that's just one example. There are, as you may be aware, there are multiple data points that we rely on, and so depending on what you're doing, you can make the tricks. But I think that's as much as I can give you for this.
You have answered that, Henry. Thank you so much. So the next question I have is for Mr. Kelvin. Mr. Kelvin, I'm going to be asking you 3 questions and allow you to answer that in 3 minutes. So the first question I have here, someone is asking, in the McKinsey & Company report on Nigeria at a crossroad, getting Nigeria where it belongs, dated December 2019. Imagine countries who have been able to generate growth and raise prosperity through poverty alleviation and the emergency of a new wave of middle and affluent class was listed as a factor. Now, here is this person's question. What role would you say financial sector could play? Then my next question for you, sir, is as a formidable player for SME lending, we know Fidelity is quite a strong player in SME lending. Do you anticipate a spike in demand after the election, and why? How are lenders preparing to ease access to meet up with the demand and increase financial inclusion? Over to you, Mr. Kelvin.
Okay, thanks, Vera. Those are very deep questions. McKinsey 2019, I think the issues are still very relevant. So I'll try to speak to them very quickly since you just gave me 3 minutes for 3 questions. The first on what role the financial sector has is the same role the financial sector has always had, which is to intermediate between where you have surplus funds and where you have needs. The issue has been how do you deepen that intermediation? How do we deepen it in Nigeria? That's the real issue. And if we're able to deepen it, that will make the difference. Now, going with the statistic that Dr. Nwani gave us, he said credit penetration to the private sector is 10%. I don't know what 10% of what, but 10%, while in developed economies, it's 120%. Question is, what is the fundamental reason? I would say it speaks to credit culture. Once we get the credit culture right, then we can deepen how much we extend facilities. And that's where credit bureaus come in. That's where if you and I are very conscious of how our credit is perceived, then the tendency is that we can take loans and be very careful about repaying those loans, and that will encourage lenders to even lend more. So today we are constrained by the typical C's of credit, and one of them is collateral. Now, if collateral can be indirectly taken care of through a consciousness of maintaining a good credit scoring or credit score, then that will help a lot to deepen penetration. So that's where banks can, that's where the financial sector can do more. We can actually help to deepen that. Do we expect a spike in demand after the election? It will take some time to come. Like we've heard, immediately after the election, the new leaders will need some time to they'll come up with their policies, and those policies will need to filter through the economy. I think that we can start seeing a spike in demand from Q4 of this year, Q3, Q4. We start seeing the effects of their policies. Interestingly, all the leading contenders speak to the same thing. They want to drive a more market-friendly policies. Now, if that's the case, then we can expect to see that the SMEs and other medium-scale players demanding for more and contributing more to the economy, and banks will be very well poised to do that. But I don't see that happening until about Q3, Q4, and then into 2024, hoping that Dr. Nwani's prediction about slowdown in GDP after election does not happen this time around, and that the GDP actually grows in 2024 after the elections. That'll be my quick answer
All
to
right.
that. Thank you.
Thank you. Thank you so much, Mr. Kelvin. We've actually almost come to the conclusion. And for all attendees, we have had a lot of conclusive prediction by the oracles we've had here today. So I believe we're going to compile all the predictions and let's see what happens in the course of the year. So I'm just going to give every panelist just 1 minute to all of you. You have a minute to just conclude, give a concluding, closing speech, just a minute. So starting with you, Mr. Kelvin, please, over to you, a minute.
Okay, I just want to say once again, thank you very much, Dr. Jamila and the Credit Registry team for this event and for inviting me to be a part of it, and Fidelity Bank. It's been a good one, and we look forward to having more of this. I think this is very impactful and pertinent also for a time like this. I also want to appreciate all the members of this panel and everyone. We had at some point almost 200 participants, and that's really great. So well done, and thanks for having me on this panel. Thank you very much.
Thank you so much. Dr. Wani, can we have you, please?
Thank you, Vera. Once again, on behalf of FMDQ staff, management, and board, thanks to Credit Registry, thanks to the CEO, Dr. Jamila, and all the organizing team for inviting us to this. And be assured that we will continue to cooperate with the organization to take this further and deepen the credit market. And my final comment is that the election is 3 weeks or more from now. Let's continue to listen to the leading contenders, especially their key policies on restructuring, on fuel subsidy, on some of these things that bother us, because credit and lending still have to sit with a thriving economy. And we hope that we have a thriving economy in 2023 post-election and years to come. Thank you.
Thank you, Dr. Vincent. So the next person is Mr. Biodo. 1 minute, please, sir.
All right, thank you. So indeed, thank you to the entire team. Credit Registry, Dr. Jamila, thank you, Vera, thank you, Steve. I'm sure it's somewhere listening to me. This is great, great opportunity. And on behalf of myself and the entire crew at AfriVest also, we appreciate this opportunity. I mean, given that it's an election year, with all of the uncertainties, clearly there are opportunities. It's just about how well you can understand the opportunities, look at the risk dimension there, and then take position. Ultimately, get involved in the process of, deciding who the next manager or CEO of Nigeria will be. I'm not campaigning for anybody, just get involved in that process. Then remember to also pray and play your part as a great citizen of this country. Thank you, everyone.
Thank you. Then the last person is Mr. Henry. Over to you for your closing remark in a minute, sir.
Okay. It's been an interesting conversation. I'm really delighted to be part of it. Special thanks to Dr. Jamila and the team, Vera and Steve and Co. Thank you so much for setting this up. Special thanks to the other speakers, Mr. Biodun, Mr. Kevin, and Dr. Vincent. It was really nice listening and hearing and learning from you all. So thank you, and to all the participants, thanks again. Have a wonderful evening. Cheers.
Thank you so much, Henry. I just want to say one word to the speakers. It is not easy to hold the attention of over 180 people for approximately 2 hours, 30 minutes. So I want to say a huge thank you to all of you. And at this point, I'm going to be handing over to my MD CEO, Dr. Jamila Sharif Ayedu, to take the closing remark. Over to you, Dr. Jamila.
Okay, excellent job, you guys. I'm going to make this short and sweet. I trust that everybody has enjoyed their lunch break with us today. We have been fully well fed by these incredible speakers. So we at Credit Registry just give our gratitude to all those who took time out today to be with us at today's marketplace and our market pulse. And we want to make sure that you remain engaged with us. We want to say that you were on fire today. All of the comments, questions were on point. So thank you for your engagement. And just remember, get out there to vote because we care. Speakers, thank you so much for taking your time. We are indebted to you. My hat's off to the entire team, the committee, the moderator, fantastic job on all you've done with the committee, the communications team for all of the efforts and the creatives that have gone out. So just fantastic job. Everyone have a wonderful rest of the day. And don't forget, get out there and vote because we care. Thank you so much. Bye-bye. Until the next time. Thank you.